Hi, everybody. Good afternoon. My name is Ted Farrell. I'm your host here for all things litigation funding. We have a terrific guest with us here today, a true luminary in our business, Mr. Jeff Lula from GLS Capital. Jeff, how about a quick intro on you and GLS, and then we'll get into it.
Thanks so much for having me, Ted. So I am one of the principals at GLS Capital. We're one of the leading litigation funding firms in the United States, based out of Chicago. And I've been with GLS since almost the beginning, since 2019. And prior to joining GLS, I was a commercial litigation and bankruptcy litigation partner at Kirkland & Ellis in Chicago.
Yeah. And so tell me, we'll get into you in a sec, but what kind of cases, what's sort of within the bailiwick, the kind of stuff that GLS invests in?
So we invest in sort of almost any type of case that has, legal regulatory risk associated with it. I run the day-to-day for our sort of commercial investments: antitrust, breach of contract, tortious interference, trade secret, even really copyright or trademark claims fall within my area, including also judgment enforcement. I've got a couple of very talented colleagues that do patent infringement claims, but I kind of handle the jack of all trades that are outside of that area. And GLS Capital has a real broad mandate in this field. And so we invest kind of across the spectrum in the United States and even a little bit internationally as well.
Right. So you guys have kind of chopped it up. So basically, the antitrust cases, the commercial cases come in. One group kind of runs with it. If it's, IP infringement focused, one group runs with it. So you've kind of like, at least the first time, kind of like tried to split it up that way.
Yeah, we've got really sort of two main teams that handle sort of traditional litigation cases. We've got Adam Gill and Joel Merkin, who handle sort of patent infringement cases. But really everything outside of that comes to me in my commercial vertical in order to take a look at. That includes trade secret, that includes copyright, and that includes sort of traditional business to business disputes, class actions. So it's a pretty broad mandate, but it makes for a lot of interesting opportunities and investments.
Right. And then are you, I think, but I just want to, because I think it's important for people calling, you guys are generally backing companies or law firms. Like you guys don't do anything where you would be doing sort of like direct consumer stuff, right? That's sort of outside of what you guys do.
Yeah. So we are, in the spectrum of litigation funding, there's sort of consumer litigation funding and commercial litigation funding. We really are on the larger business commercial litigation funding end. And realistically, that's, investments that are roughly $1 million or larger, and really sort of the types of disputes that warrant that type of investing. We're not doing some of the smaller post-settlement individual claims. That's barely litigation funding in the way that we think about it. And I mean, like you and I, Ted.
Yeah, and I think it's just a different business and a different kind of transaction, different counterparties. Okay. So I want to talk about your thoughts on the state of the market, some stuff you're working on. But before that, and I ask everybody this because I think this is sort of a good way to kick into it. How did you first get exposed to litigation funding and then, eventually find your way to hooking up with the GLS team?
So when I was originally asked these questions early on in my litigation funding career, I didn't have a lot of experience till I got into litigation funding. I actually need to now go back and amend that answer, because at Kirkland, I worked on a bankruptcy case called Shopco. It was a sort of retail company, a little bit similar to like a regional Target. We represented
what was it called? Shopco?
Yeah, Shopco.
That sounds like a mock trial made up company, Shopco. But
it's a real company.
If they were real, they were real. That's fine. Okay.
Yeah, throughout the Midwest, heavy in Wisconsin and other areas.
Okay.
And I was the lead litigator on the case. We had some great bankruptcy attorneys at Kirkland that worked alongside me. And it was a tough case. I mean, these retail cases in light of Amazon struggled quite a bit. One of the things we had to do is we were just selling all the assets. One of the assets was Visa MasterCard claims and sort of the large interchange class action. So we basically ran a process to sell these assets, these litigation assets in the Visa MasterCard claim, and sold them to a litigation funder. Now, it wasn't what I was typically thinking of as litigation funding, but it was the exact same experience of valuing, monetizing, and honestly selling to a funder those assets in the bankruptcy. And it wasn't until I was in litigation funding and read an article by a friend of mine referencing my own case that I realized that that counted. So,
and so what you're, what you're talking about there, and I think that the people listening to this who are sort of like day to day inside the biz know what you mean. But I think what you're referring to is, and just to make sure, is there was a long running antitrust case about Visa and MasterCard, and the fees charged for using them. And so what some companies did for liquidity is to say, right, this case is going on. We think eventually there'll be a payout, but some companies like your client wanted to de-risk and take the money today. I mean, that's sort of what we're talking about.
That's exactly what it is that it was this large interchange class action. Basically, it was, I think the theory was antitrust against them for conspiring or holding up the prices by Visa and MasterCard. And a lot of companies were selling their place in the class action for money. And Shopko was in bankruptcy. They were in need of liquidity. And this was an asset that people were willing to pay money for. And so we kind of ran it like an auction and sold it off. And that was sort of a unique experience to have. But in some ways, most of what you do inside of bankruptcy is sort of adjacent to litigation funding, because you're constantly needing to view everything through the lens of litigation only so much as it could be valuable to the debtor.
Right. And, I think that it is a very common tale that people kind of get their first taste of litigation, or at least a claim as an asset, through bankruptcy. And I think a lot of the sort of multi-strategy hedge funds that do some litigation funding, it's the same thing. They notice, hey, this company may recover X dollars in 5 years, but we need money today and we can sell it now. So I think that's kind of an interesting perspective on how you're looking at, where is like the value in a company and a claim.
Exactly. The distressed investing market has been around for decades and decades. And in some ways, litigation funding is just a more specialized and broader version of it.
Right. So you're talking about you're running this process to see what these are worth, and this kind of dovetails pretty nicely. Something that I think when people go to the market for, so let's say you were a partner in a law firm and you didn't have much experience in litigation funding, or you're a claim holder looking for litigation funding. Something that I think people spend a lot of time on, and I know you guys do because we've certainly looked at deals, is valuing, right? What is a claim worth? So I think it'd be like really helpful. Like, can you start with like sort of the broad overview of how you, as someone who is potentially being asked to provide the liquidity and take the risk, how do you go about trying to, project a potential value on a piece of litigation? Like, what's sort of like the approach and the big things you think about?
Yeah, I'm happy to kind of walk through the steps of how we think about it. And, obviously every case is different, but in some ways, on the litigation funding end, it's kind of unique to have rep after rep, try after try, see so many different cases and be able to refine your thinking on how to evaluate this. But a lot of the time when you're looking at sort of a single case, you're looking at a breach of contract case where someone's coming to you because they need funding for fees, costs to sue a large company, you're starting to look at kind of the contours of what the case looks like. What is the budget? What's the money you're having to put out? But then what is the likely recovery at the end of the day? Now, those sound simple, but if a company paid $30 million for a piece of equipment and got nothing, that 30 million recovery seems pretty concrete, pretty solid. But if instead you've got this idea of lost profits, if the business would have done better, then you've got a little bit more speculative recovery. And you kind of have to judge those differently because in the end, juries and judges and fact finders view those differently. Some are more solid and easy to recover than others. So it's not that all damages are created equal and you're almost discounting them as you go along. Then you kind of run into the duration part of litigation, which is really hard to figure out because at the end of the day, cases tend to take longer than you think, but also you don't have a lot of control or predictability on it. I had a case that we were following where a relatively simple motion sat in front of the judge for almost 3 years without getting ruled on. And it was just a 3-year delay in the case. It's hard to predict that, but it happens enough here and there that you need to take it into account. And so you're kind of looking at the recovery at the end of the case. You're trying to net present value what the case looks like, what settlement off ramps can look like, and kind of the reality that even when you have a successful judgment, you've taken it all the way through the risk points at summary judgment and at trial, it still isn't collected yet. You've got post-trial motions, you've got appeals. So really when you break it down, if you're kind of looking at litigation funders, if you're talking to them over, a beer in terms of how do we really break down cases, a lot of it is thinking through the scenarios and the risk points, trying to put quantitative numbers and risk profiles on that until you're able to see what are my chances of losing at motion to dismiss? What are the chances of losing at summary judgment? What are the chances at trial? Trying to sort of mold those all
Well,
together.
the cases I work on, it's a zero at every stage.
I mean, that's what everyone tells you.
There's zeros. You can't lose. How could you lose?
Exactly. And,
Right.
those are obviously the best cases, the ones that are guaranteed all the way. And so it's really like, in some ways, this is all on one level common sense, but on another level, sort of the adding to the quantification and adding the rigor to basically actually writing it out, because an attorney's instinct on what a case is worth sometimes is very different than when they actually map out all of the risk points that go along with it. I mean, I spend a lot of time talking to general counsels, CFOs, and leading litigation partners about what their cases are worth. And sometimes, it is very different and sometimes surprisingly unsophisticated at times in terms of how other people in our field may view that.
Yeah, and I think that's, I think it's natural that a law firm is going to look at the high end. And by the way, you want them to believe in the case. And it's not that they're snowing you and selling you. But one thing that I think makes this so difficult, but, in some ways so much fun, because you really need to get 3 parties to kind of agree, is the law firm is the only one making money along the way, right? So if it takes 5 years or it takes 3 years, for the law firm, if they've been clipping their fees, it's easier for them to wait. The company might not be able to wait 5 years. But then for the funder, because I think you brought up duration, and I'm glad you brought it up, because I continually tell people that, and by the way, I tell people, the law firms and sort of the claim holders I work with, that duration is what keeps you up at night, because, the legal merits are what they are, and you can underwrite those, and the evidence of damages is the evidence of damages, and the quality and experience of lawyers is lawyers. But like you said, that thing, if a motion sits up there for 3 years, the clock is ticking, and that's blowing up your return. So talk to me a little bit about, the duration risk and valuation and net present value and all that stuff. Because I think duration is really a huge, huge, huge factor in our business.
Yeah, I mean, it kind of goes into every part of how you think about it, because the longer the case goes on, the longer you are to money, obviously. Yeah. But also the longer the case goes on, I mean, realistically, the more expensive the case becomes.
Right.
It's hard to keep a budget in control when a case goes on 3 times as long as you would have thought. So it kind of feeds on itself in many ways. And we're just trying to be really cognizant and thoughtful about that. And in a strange way, as a litigation funder, and this is I contrast it to being a partner at Kirkland, is that I see so many more cases now than I ever did when I was practicing law, because I talk to people, I follow cases, people pitch us cases, we invest in cases. I talk to really knowledgeable people in the field like you, Ted, and we just sort of get a really good overview of what's going on. And that isn't necessarily what a day-to-day lawyer does. So in a strange way, I've got dozens, hundreds, thousands more comparison points for each case that I'm trying to evaluate than even the most talented, even the smartest, even the most eloquent trial lawyers out there. It's just a different skill set that we bring to the table. And in a way that I think can be really helpful to the lawyers. Can be really
well, you have to, and you have to embrace it, because some people say, well, but I'm 60 years old and I've tried 85 cases in 40 years. How could Jeff possibly have a view I should consider on how long this is going to take? And, the answer is because I've, in the last 5 years looked at 300 cases and I've closely followed 85, right? Or like whatever that is. And I think people should be bear hugging you, because the more data points you have, right? The more data points you have, the more you can figure out about your case, right? And what are the strengths of my case and what are the weaknesses of my case? And I think people should be bear hugging people at the funder.
I mean, sometimes they are, but sometimes you have to give them the answers that, they don't want to hear, which is sometimes a more conservative or a more realistic view on what the likely outcome is to be. And I sometimes find that the CFOs are the ones that are really able to handle and think about it in the way we do, because from their perspective, the litigation is an expense they have to pay and a potential recovery at the end of the day, and they're less keyed into the day-to-day motion of it, while it's easy to get really emotionally invested in your case, be it as a litigator or as the in-house counsel overseeing it.
Yeah, and just because your case is good, and just because you're actually right on what the law is, doesn't mean you're going to win, right?
Yeah.
I mean, and that's just like and like really good lawyers know that. I get it, but that's what makes this, I think, such an interesting, asset class and business to work in, because you can, like, put it this way: if you're in real estate investing and you look at the historic rental rates in the building, barring calamity, you can kind of guess what's going to happen, right? And it just kind of doesn't work that way here. Anyway, okay, so let me ask you this. We hear a lot, and I think this is an extremely coordinated, and in a lot of ways, I don't want to say effective, but a lot of hay has been made out of there's no transparency in litigation, and it's all behind the shadows, right? GLS Capital publicized that it was involved in a case for a company called Nanico. I think I'm pronouncing that correctly.
How you pronounce it.
So I was not pronouncing it correctly. What a shocker. I'm sure audience will be shocked. But I really am interested in how much you can tell me about the decision you all made to public. And I want you to talk about how you talked with the company about it, but I'm interested in sort of hearing about how you all decided to do that and what sort of the reaction to that has been. So, and you can talk a little bit about the case too. I think would be really, really interesting.
Yeah, I mean, so the Nanoco litigation was a patent infringement litigation related to quantum dots. It's sort of this technology that goes into higher end TVs, in particular, some of them being manufactured by Samsung. And maybe I'll even step back for a second about sort of publicizing cases in our industry, because this is one where, we were able to publicize it, but in a way, I wish my answer was more satisfying. It was kind of regulatory reasons for the Nanoco company that sort of made the whole setup with GLS necessarily public. And it just so happened that it turned out to be a really great outcome, and one that was beneficial to the company, beneficial to GLS, beneficial to all the stakeholders of Ninoco. And everyone kind of came to a good result in that. And I think, has been one that has been picked up, not just by us, but kind of the litigation funding industry generally, as an example of litigation funding kind of at its best, being able to fund fees and costs and go up against well-regarded, highly capitalized defendants, like Samsung in this case, and be successful, be able to reach a resolution. One of the personally frustrating parts about our industry is that I have lots of really successful outcomes from investments I've made and companies that I work with that I cannot tell you about, Ted, because they're under NDA, confidential.
So you're like the kid in high school with the secret girlfriend. Who
That's
lives in
exactly
another country,
right. All of my
and you just wish you could tell everyone. Yeah,
yeah, but it's sort of the nature of the industry is that they don't want to talk about it. We have some of the confidentiality in place, but I sometimes think that it would be better if, as it became appropriate and the companies are able to, and funders are able to sort of give more examples out there of litigation funding being used to really help the David versus Goliath setup be able to reach a more successful outcome for parties that need the money and have really meritorious claims. And I think there should be more of a push to be able to make that more available, but it's really tricky because the companies can be really sensitive to it. It's hard to do in litigation. Funders don't really want to open themselves up to subpoenas and discovery. And so there's just sort of a lot of countervailing issues that come with it. But I do think that there's been a little bit more of a movement in the industry to allow some of the cases to become more public and to ask counterparties to do that. And I think that, you'll see more of that as it goes on. But Ninoco being a great example.
And I think that, but this sort of attack it's shadow way. People can just say litigation funding is dangerous and cases are all frivolous. And, so when I think of like one case where I believe it's public, there's been funding is in the opioid litigation. And I think the defendants had wanted discovery of the funding agreements. And I believe what happened is Judge Polster, I think it's Judge Polster, reviewed them in camera and said there's no conflicts. But interestingly, I asked the Chamber of Commerce if they think that the opioid litigation was frivolous, right? And maybe if they think maybe there's not enough opioid wreckage in the country, maybe I guess that's their problem, not ours. But yeah, I think it's an overblown thing, but it's a great straw man attack because you can't, right? You can't answer or prove the negative.
I mean, at least on the frivolous point, it's one that really is frustrating for me on this, because if we were investing in frivolous litigation, we would lose money and we would stop to exist as a firm. You don't make money by investing in cases that aren't good. And in fact, it's pretty much the opposite. I mean, you can see this in articles and disclosures all across our industry that, what is it? I mean, Ted, you probably know as well as anyone, 95% of cases that are brought to funders wind up getting rejected because we wind up having to be very selective in the types of cases that we're able to offer, because they have to be a certain size. They have to be meritorious. One of the frustrating things can be they have to have proof of the merit early on. We can't invest in a case where we think in discovery it might prove up, because we're sort of investing at an early stage and we sort of need that information, that confidence going on.
So we talk about, case being meritorious. Because so many cases are rejected, I would argue that both the fact that there has been some sort of a wrong can be shown, but then to be meritorious, you have to show a wrong that also leads to a legally cognizable claim, right? So if someone has a sharp elbow with you in business, right? I'm sure people call all the time and they're upset about something, but that doesn't mean it was illegal, right? So, so for a case to be meritorious, right, we have to hit a couple hurdles, right? equitably you have to be there, but then legally you have to be there as well. And I think that's where a lot of cases fall out.
That's exactly right. And it's, it's difficult sometimes to try to figure all of that out. And the litigation funding industry, myself, sort of as one of the leading head practitioners, is, and one of the many funders in the United States that are sort of at the upper echelon of this in terms of funding numbers of cases. We tend that when there's a lot of uncertainty on a case, we just take a more conservative slant. We're less likely to invest in it. And that's kind of what you have to do because litigation is so inherently risky.
Right. I think that the risk is huge. So I'll ask you one more question about regulation. So for those who would write op-eds and say that the industry is not regulated, I think your fund is regulated by it's called the Securities and Exchange Commission. Is that true? The SEC?
Yeah, this small little organization called the SEC that has a tendency to regulate most of your financial institutions.
Oh, right. So are those sort of like, best practices, or do you maybe fill out some paperwork for them? Well, paperwork?
There is some, no doubt.
Okay. And then certain courts have local rules about funding. Is that true?
There are local rules about funding, no doubt, throughout the country.
Okay. And then some state bars have rules about funding as well?
As well as, ethical rules for everyone involved in litigation.
And the attorneys are subject to those rules? Is that how it works?
That's how it works.
What if they pro hoc into another state? They don't have to follow those rules, right?
Of course they do. States are quite strident on making sure the attorneys follow the rules, Ted, as you
right.
Well
so besides all the rules, there's no regulation. That's what you're telling me. There's an unregulated industry which has to follow all sorts of rules. Is that what you're telling me?
We've all read some of the criticisms of the industry, and you make a good point through examples there. In terms of kind of all the barriers that exist on it, in kind of keeping litigation, keeping the incentives aligned, the attorneys are going to do what's in the best interest of their clients and their ethical rules. And if it's a little bit frustrating sometimes to see that, but it is what it is in terms of what people sometimes try to say in terms of litigation funding. Sometimes that just seems like it's parties that don't want plaintiffs with meritorious claims to be able to bring those claims.
And so if they want to see the funding agreement, they also want to see all the work product behind it, even if they don't. Is that sort of your view?
My view has evolved a little bit on this. When I first got into this industry, I think there was a lot more push by your average defendant to try to find out about litigation funding. I've actually found in the last couple of years, more defendants have started just shrugging their shoulders at the existence of litigation funding, not really sending subpoenas, not asking about it. Part of that is because courts have started to largely, restrict discovery into that area. But I also think that they've kind of learned over years of practice, and the attorneys have learned that there really isn't a there. We are providing money because we think the case has merits. We basically have the same information, or often less information, than the defendants have about the case. And so there really isn't anything to be found out by the funder in terms of the actual merits of the case. I'm sure they would like to know the budget and like to know some of the economics associated with it, but that really is irrelevant.
And so that's easy. Yeah. And the way I say that is we just need to see your all's budget too.
And I'm sure
your success fee.
Turn it over.
Yeah. Just give us your budget. That's totally fine. And be careful of making bad law because your partner's in another office or working on funding cases. I do think that's a lot of what has slowed down is that, law firms are just generally embracing this as if they have a good case, they're going to do it. And, we don't want to have sort of that side skirmish.
I think it's also just not worth the money in the end to spend $5,000, $10,000, $20,000 on a fight over funding, trying to get the agreement. Usually they lose, even in the circumstances where they have perhaps an arbitration, it doesn't seem like anyone ever does anything with it. So I think they've learned that there just isn't a lot of value there, that they're not finding, GLS Capital is doing anything particularly interesting. We're just a company that's investing in litigation based on the merits. We must think it's good.
I think you're super interesting. So I don't want you
Thank you
guys
very much.
to play your stuff. Yeah. All right. So you, my friend, went out on a limb this year. In January, you wrote a big prediction and trend column for Law 360. And we talked about a couple of things here. We talked about bankruptcy. You talked a little bit about that. We talked about regulation. But there's two things that you hit on, and I'm really interested to just get your thoughts. So one is, you saw the use of insurance as a burgeoning piece of this business. I've certainly seen that. So where do you see that going? And how does the use of insurance-backed investing at all affect sort of GLS's typical strategy?
So I'll break kind of insurance in the litigation industry kind of into two pieces, because, one of the largest pieces where insurance got used was judgment preservation insurance. So this is when someone has a successful jury verdict or a successful bench trial, they've got a damages award, and it's, usually going up on appeal. Some insurance companies were offering policies where if you were unsuccessful on appeal, they would still pay out a premium, some percentage of the award with, certain conditions and premium costs. That part of the industry, grew and grew and grew so fast over the last couple of years. But I think what we're seeing in the last 6 months, 9 months, 12 months, and really quickly this year is that area is starting to shrink more and more. There seems to be a lot of insurance companies that are starting to realize that litigation, even on appeal, can be quite risky, and that some of the insurance companies are starting to face policies that are going to have to pay out large numbers. I mean, some of these have made, I think there was a Wall Street Journal article about Liberty Mutual and some policies related to litigation. And so that area seems to be shrinking. Definitely in the patent space, it's shrinking. I think even in general litigation, it will still have a lot of import just because it's a useful thing for people to de-risk, but it seems to be, shrinking a little bit over time. On the other hand, insurance for individual claims, campaigns, which is just sort of like a lot of claims under a similar theory. This is often in patent, but can be in, antitrust and other areas, or portfolio of claims seems to actually be growing more and more as JPI has sort of slowed down a little bit. So really the growth in insurance seems to kind of be evolving to the risk, as the insurance company seems to be trying to get their hands around what types of risk they're comfortable with and what types of risk they're not. And this is growing kind of side by side with litigation funding. There's a lot of areas where we work, hand in glove with insurance companies in order to, help litigants bring claims forward. And there's some areas where litigation policies and litigation funders are sort of in competition, at least in part, with each other. But, I sort of stand by my article, although sort of the development has happened in maybe different areas than what I originally thought.
Right. But the only thing I'll push back on there is even on wrapped deals, right? On a wrapped insurance deal, the claim holder of the law firm never wants to go out of pocket to pay the premium. So, right, like, oh, we can de-risk this for $50 million, but we owe $10 million up front. Well, where does the 10 million come from, right? And so I think that, I think if anything, insurance is becoming a piece of the financing, but the actual, the straight up cash that's due at the closing, those wires are generally coming from entities like GLS or others that deal in legal risk, because obviously there's still risks around it. There's duration. If you win, is it collectible? If you don't, is it not collectible? Who takes the risk if it takes 5 years and the insurer becomes insolvent? So I think that, that is, the idea that insurance is going to swallow litigation funding, I think, is a long ways away.
I mean, at the end of the day, there's risk in litigation of losing, and someone's going to have to take that risk. If it's a funder, if it's an insurance company, if it's a combination of both.
Well, I'm not, just not me. As long as I don't take it.
Yeah, so long as it's not Ted.
It's not me. That's right. That's right. But there's so much risk out there for everybody to take, so they can totally do it. Okay, and the last one I want to hit you on is you had mentioned that you thought the market for secondary transactions, and again, did you guys maybe publicly do a secondary this year?
We did publicly do a secondary transaction this year. We did a deal with Omni Bridgeway, another, very large litigation funder, where they were looking to, sell off a piece of one of their funds on sort of their intellectual property end. And we bought a piece of it, and, it kind of helped them with their fund. It was able to get us a diversified piece of risk. And it kind of goes to show, and secondary transactions is really just selling off a piece of sort of, a litigation funder, really, this goes broadly in the financial industry, a piece of an already kind of put together fund or set of cases.
Yeah, for sure. And it makes tons of sense. It makes tons of sense for everybody.
And especially in our industry where, litigation funding has now been around long enough that you have funds that are coming to the end of their life, because, typical litigation funder is raising money with LPs, putting out the investments, they're harvesting, they're closing, they're getting the money in, but not every litigation is ending at the same time. So there may be kind of lingering pieces of that, and being able to have a mature market where people can buy them from each other to close out funds, to bring in cash, is really, being able to see that, being able to participate in it, just kind of shows the health, the maturity of the market. It offers a lot of benefits to us. It offers benefits to the investors in the market, but it's also just a really good signal, I think, that this is a market that's kind of working efficiently, working as it should, and kind of continues to have and generate value.
Yeah, and I think there's less reticence to do it because, there's just more people who've been in the game for 8, 10, and 12 years and can say, hey, if I were in their shoes, right, and harvest was over, I can ask for 2 1-year extensions, but these are 3 or 4 years out. Like, I think enough people have enough experience that they don't feel like suckers for even looking at it, right? Like, what is this? So there's I feel like secondaries 3 or 4 years ago was code word for distress, right? And that is not least. Look, there's always going to be distress in any industry, right? But I think that there is going to be a lot more action there. And I'll tell you, I am, looking at more of these, we'd like to take a mark. We'd like to sell, 20% of this because it's going to help us raise the next fund. So I think that is going to continue. And I will give you all the credit for pulling the trigger on one of these, because a lot of people they're just so wary of what they don't know. And it's like, well, you can underwrite it, right? Here's the funding agreements. Here's the economics. These are the cases, and you pay that. So I think that's exciting. You all did that. And I do think we're going to have more of those. All right. So Jeff, most importantly, now that someone has, you've cast your spell over all of our listeners, how they find you, how they find GLS, what's the best way to get connected with you guys?
Easiest way as always is the website, glscap.com. My email address, direct numbers on there. I'm pretty active on LinkedIn right along with you, Ted, trying to be, out there in that regard. And really, I think one thing that I'd like to say in particular for, the companies out there that are looking at litigation, for, attorneys that are sort of dipping their toe into this area, is feel free to reach out even before you have a fully baked idea. Because a lot of
the only time I reach out. That's the only time I reach out.
Exactly.
Right.
Because a lot of the time, we're able to give you an immediate reaction on a case that may help you kind of know whether or not it's a good fit for funding. I'm starting to get a lot of attorneys that'll call me for suggestions about, or a lot of companies that'll call with suggestions about what kind of counsel should they talk to and making introductions on their behalf. In a way, litigation funders are kind of like the intermediary networker in the middle of the litigation ecosystem. And so we're just sort of introducing experts to attorneys to companies. And we do a lot of that even for cases that we don't fund, because it just kind of keeps us involved and knowledgeable because we know so many people. But at the end of the day, if you've got a case, if you've got an interest in it, feel free to reach out directly. We always take inquiries with respect to that. Again, was it glscap.com, GLS Capital, and feel free to reach out to me directly.
Awesome. All right. Well, Jeff, it has been a pleasure. And I'll talk to you soon, man.
Absolutely. Thanks so much, Ted.
Bye.